Yeah, ladies and gentlemen, welcome back. And this is again the lecture on General Introduction to Tax Law, though that is the beginner's lecture. And today I wanted to do a favor to myself and just, yeah, talk a bit about one of the later chapters because always the same sequence of the same things that can be a bit boring. So let's turn to one of the later chapters. The other ones missing naturally will come later. We don't skip them. But this is just to give you a first overview about inheritance tax, because otherwise that gets completely lost at the end of the semester and everybody forgets it. So, inheritance tax, what is it all about? I told you in one of the first lectures online, which I have uploaded, that we have different types of taxes. The ones on the money which you get, taxes on income, the taxes on the money which you have, taxes on property or wealth, and the taxes on the money which you spend, so on consume. And now the inheritance tax is a very good example for a tax on the property which you have, because here all the wealth which a person has is taxed when that person dies and the heirs get his or her property. Then very often in many states you have a tax on inheritance. Under formal aspects, you can design that tax as a tax of the heirs, so which the new owners have to pay. That is done in Germany this way. Or you can design it as a tax on the estate, so on the full property which the dying person leaves behind. That's rather a formal difference because the economic effect is the same. Either you die without debts and your heirs then get 1 second after you died an own liability from inheritance tax, or when you die 1 second before you die, still an inheritance tax liability comes into existence and you die without having paid it. So that's rather the English system. So we can bring forward the rather not very seriously meant idea that no Englishman in England can ever die without leaving behind unpaid debts. That is the inheritance tax debt. Whereas a German can usually die with a clean conscience. If you pay off all your debts, you will not get an additional inheritance tax debt on the last second of your life. That will be the problem of your children, even legally. In reality, naturally, makes no difference. Huh? Okay, so the basic idea of such a tax would be when you die, let's say in Germany, and leave behind 1 million euro, or better, if you don't die but you get the 1 million euro from your father or mother, then a certain amount would be regarded as tax-free. That's rather to spare the average, let's call it customer, the average family member, and only tax the ones where the inheritance is rather high. But still 600,000 taxable property, would be left over. The tax rate is fixed here at 15%, so you would get an inheritance tax notice about 90,000 euro to be paid soon. Now, what makes an inheritance tax probably a bit inconvenient? Well, naturally, we have the same principle as we have with revenue under income tax. You can't look only to cash and money and bank accounts. It can make no difference if somebody inherits property in form of cash or in form of other things, for example, in form of houses, pictures, paintings by Rembrandt, or in form of furniture or other stuff. So you need to value all the individual assets which go over to the heir, and probably you will also have to deduct liabilities, because naturally if you inherit 1 million but also have to take over debts of 999,999, then you practically inherit nothing, because you only are left behind with a nice duty to pay off your father's or mother's debts. So yeah, but in principle you will have to calculate the value of the complete net property which you inherit. Exemptions are only possible for reasons of simplification. For example, a ball pen in the household of your deceased father, nobody will care about the value. So such low value everyday assets which are present in every household, that can probably be ignored, but for that you would already need a legal basis. So there will be a free allowance for furniture and other household chattels which you inherit from somebody in your close family. That a certain amount can be ignored as tax-free, because very often you can't even use it but throw it away. So the market value would nevertheless count at the moment when you inherit, because you throw it away afterwards, so you first got it. Then naturally, when inheritance tax, as it very often does, also covers gifts, donations which are made between living persons, then naturally you need also some common sense. A birthday present cannot be subjected to inheritance tax, or a present which you get when you finished school successfully or made a bachelor degree or so, then perhaps your parents congratulate you and hand you over some nice present. That would also be disregarded, usually just for practical reasons. You can't follow it up. It would spoil every person's life, and the bureaucracy costs of covering that or checking all that would be far higher than any reasonable tax amount which could come in. Let's have a close look on free allowances. There has been during the last decades a widespread tendency in many countries to make inheritance tax less and less important. So free allowances have been continuously increased in many states. There are even many states where inheritance tax has completely been abolished. In Germany, at the moment, free allowances depend on the family relationship to the person from whom you get the property, and there is at the moment a free allowance for acquisitions which come from your husband, wife, or life partner. That means civil partner, 500,000 euro. A child, 400,000 euro. If you have, or if you had a child who is already dead and gone, and now that child is replaced by a grandchild, so a child of a dead child, then that child would also inherit father's or mother's free allowance. If you leave something in your last will and testament to a grandchild whose parents are still alive, then the free allowance is 100,000 only. Brothers and sisters are regarded as relatively far away family members. Depends on how you see your brothers and sisters. Evidently, we had members of parliament or members of the financial ministry who rather had a distant relationship to their brothers and sisters. So don't know why only 20,000 are allowed there as a free allowance. Well, be it as it be, let's go on and have a look on the rates. The rates also vary in the German system according to the family relationship. There are tax clauses for the individual part of the family. The most close part of the family are tax clause 1, that's husband, wife, and naturally, I forgot that on that slide, life partners. Children, tax clause 1, brothers, sisters, tax clause 2, nephews and nieces, tax clause 2. Grandchildren is tax clause 1 if the parent which connects the grandchild with granddad or grandmother is already dead. If that intermediate person is still alive, then grandchildren are tax clause 2. And non-related persons or juridical persons or special purposes to which you dedicate money, all the rest remaining rubbish would be tax clause 3 with the highest rates. By the way, naturally, a good idea to lower tax rates under the German system would be to marry before you make a donation or before you make somebody your heir, or it would be a nice idea to think about an adoption, because an adopted child is a child under the inheritance tax class system. Well, the tax rates in the tax classes are progressive. For example, in the lowest tax class 1, they begin with 7% for a relatively small amount and then go up and up and up for the highest amount of money which you can inherit. The highest rate in tax class 1 is 30%. In other tax classes, the highest tax rate can climb up to 50%. But now, that means if you inherit or get as a donation a small amount, small rate. If you get a high amount, high rates. Now, what are necessary conclusions from that? Implications for the design of a tax system? Well, if you just leave it as it is now, as I explained, high amount, high tax rate, low amount, low tax rate, then naturally all intelligent people would just split up every planned donation into several separate donations, and each one would be taxed separately. For example, instead of giving somebody 1 million, which leads to a tax in tax class 1 of, let's say, I believe in reality it would be 11% under the present way. Don't know exactly. But at least, let's say you pay 7,000. Free allowance of 400,000. And then you would perhaps say, okay, instead of paying 15% on the occasion that I get 1 million, I would probably split it up into 2 separate donations of 500,000. Then I get 2 times 7,000, which is far cheaper. Or I would even split it up into 3 separate transactions, and everyone would be tax-free up to 400,000. And conclusion, ladies and gentlemen, naturally, there's one simple statement which we can make: that can't be simple. Well, that would be so simple, then you could abolish the whole tax straightforward. So there must be a mechanism which avoids that. So the unwanted splitting up of one transaction into several ones. Now in Germany that is done by a 10 years rule. Every transaction within the last 10 years between the same 2 persons involved is just added up and treated as a single transaction. And so if something new happens, for example, if a third transaction comes on top, then the case is reviewed and the first, the second, and the third transaction are treated as one single event. Tax is calculated for the total amount transferred at the total tax rate with the adequate progression. And the only thing which is done is the tax which you have already paid at the former assessment, when only the first 2 transactions were known, will be credited to the final tax bill, so that you only pay the exceeding amount. So that brings along that the progression is always restored or kept up. For example, if in year one you got 500,000 from father, then 400,000 were tax-free, 100,000 were taxable, 11% would be the tax rate. Yes, I had that wrong on the slide 2 slides ago. So 11,000 would be taxable. Now finished, done. Some years where nothing happens, and in year 8, father can't suppress his benevolent instincts and gives you another 500,000. Here, child, here they are. Now you got additional 500,000. So, as this is still within the period of 10 years, the calculation is redone, and now it starts. Everything is taken into account. 500,000 from year 1, 500,000 from year, that should be 8, total 1 million. Free allowance is 400,000. As this is now treated as one single group of events, you get the free allowance only once, 400,000. So taxable amount remaining 600,000, adequate tax rate for that under the German tax class 1 is 15%, so you pay 90,000, or you have to pay 90,000. At the earlier date, they took away already 11,000 from you, so that means that 79,000 are still unpaid. That will be claimed from you in that adjusted tax notice, which you then get when the second event occurs. Well, good. And we have already mentioned that between the lines several times, the gifts or the donations. What you can see from the previous example is that if a state has an inheritance tax, they will usually also have a gift tax, or they will apply that inheritance tax to gifts and donations too. That has rather a very, very simple way to explain it. Very simple reasons, because imagine inheritances would be taxed, but donations would not. Then in the last moment of my life, when I feel that death is coming, and when doctor says, yes, death is knocking on the door, then I would probably say, send for a notary. Not for a priest, but for a notary. And if the notary arrives in time, I would dictate, not my last will, but I would dictate that I give as a donation, as a gift, in my lifetime, now immediately, all my property to my son or my daughter, so that they get it, and I die poor. And if I die poor, having nothing at all since 1 o'clock in the morning, 1 o'clock p.m., if I then die at 8 o'clock in the evening, I die completely poor. Nothing is left which could be inherited, so no inheritance tax would ever be due. And as this trick is so plain and simple, you can draw not only two conclusions. Either you forget about the whole thing and abolish the inheritance tax, or you include the gifts. And naturally, if you include the gifts, you have to go back a certain period of time, because not everybody is so lazy that he or she just reacts on the last day of life. So you would have to go a bit backwards, and the English, for example, have made the solution that inheritances are taxed, and all the gifts which were made during the 7 last years of life before death are added up to that taxable amount. In Germany, they chose a different solution. Every gift during lifetime is taxable, but to keep the overview, only events during a period of 10 years are added up together, so that you don't have to dig up the last 90 years of the past. Somebody dying at 90 leaves somebody to to a friend who is already 85, then you don't need to go back to the time of birth of both people involved, but then simply have to follow up what happened during the last 10 years. You usually follow that up by asking the people they have to fill out a tax return, and you know if they lie in that tax return, then they will face criminal prosecution because of tax fraud. Good. So every inheritance tax will include a gift tax, otherwise it will break down. Now, economic consequences of inheritance taxes. Well, what happens if you are a business owner, you have an equity of 1 million and then you die? And the answer is, well, the new owner does not have any equity of 1 million anymore because, let's say, what did I say a minute ago, 150,000, for example, would be gone immediately because now the owner has to pay 150,000 relatively quickly to the fiscal office, so the equity goes down to 850,000. Imagine it's a really rich enterprise or owner, then it would be tax rate 30% or even 50% if it's tax class 2. Then 30% or 50% of all the equity of the firm would be lost immediately within a very short time, and that would probably weaken the economic abilities of that firm to grow and maintain itself in the market. So the risk of failure goes up. The banks will charge higher interest rates due to the lower equity, or they will even foresee that such a thing might happen, and so might already charge you higher interest rates in the beginning, already before the whole inheritance tax affair happens, just with the perspective it could happen. So life becomes more expensive and dangerous for enterprises. That is a reason why many states see inheritance tax as dangerous for the survival of an enterprise, and some have decided to abolish it. Others have decided to levy inheritance tax only for private property, but not for business property. Just the idea, we spare our businesses and don't want to inflict them pain and risks. Now, focus a bit on that last policy. You tax private property but not business property. You know that people can contribute property to a business. So naturally, if I feel death coming, I would probably try to contribute all of my private property, where that is feasible, to my business, so that it, when I die, is a part of my business and will be tax exempt. Naturally, a state which is not completely brainless will have to react to that simple tax saving model and will have to erect a kind of a firewall between the private and the business property with effect for or in relation to inheritance tax. So there will have to be rules what can be accepted as genuine business property for inheritance tax purposes, and with where the advantages of the tax exemption for business property or similar favors will be revoked or not given in the first place. That usually then makes things complicated because, well, you can always shift your property to a business. Then for these countries, how to draw the line between genuine business property, which can get the favor of being untaxed, and private property. That's for them the big question, and it's really nearly unsolvable. Because if you try to define rules, you have to supervise these rules and you end up in a heap of bureaucracy, which is probably not feasible. The other problem might be you might renounce on tax for businesses, property for business, although that is perhaps not necessary. A business might have enough money to pay the inheritance tax, so you end up in endless problems concerning justice and fairness concerning the tax. At the moment, the solution in Germany is that we have, in principle, an inheritance tax on private and business property, but that the amount of inheritance tax which refers to business property can be reduced on application or can even be renounced on if certain conditions are fulfilled. So we privilege business property if conditions are fulfilled. And now we are exactly in that complicated situation that we have to make sure that business property is not artificially increased by private property, which has been transferred into the business sphere. And then naturally another aspect comes up. Is it really just and fair with regard to all the other taxpayers that they have to pay inheritance tax on all their cash and houses, so what they get, whereas the business owners get away no payment? There we had many constitutional court decisions. There has been a sequence of always repeating court decisions. In 1996, the inheritance tax rules were denounced as unconstitutional because treating equal things unequally in an unfair way, an unjustified way. So the Constitutional Court said that the inheritance tax law should be reformed. In 2009, the same thing happened. 2016, we had again a reform due to a Constitutional Court decision, and this is probably not the last time when that happened, because the matter gets more and more complicated, but the criticism, the basic criticism, how can we justify unequal treatment of basically the same thing, property, where each form of that basically same thing, property, can always be, if you cleverly behave and know the rules, be transformed in another more favorably treated form. Well, economically, you can always, if you have time and know about what you have to do, you can always transform one form of property into another form. If you have a building, you can sell it, turn it into cash, buy something else which is taxed at a lower extent, or if cash is taxed higher than buildings, you can take all your cash and buy a building, and inheritance happens, heir gets a building, lowly taxed, then afterwards sells the building, has again cash. Probably what you saved is higher than the cost of these transactions. So that's always a very, very risky thing where the line is very difficult to draw and to defend, especially. Another problematic field which we had in Germany is the treatment of houses under inheritance tax law, because originally for real estate tax, for property taxes and many other taxes, there was a system that houses and pieces of land should be regularly all 6 years evaluated according to their market values, and that so-called Einheitswert system was practiced from the beginning onwards. Now there were some bureaucratic problems because they had not enough people to do it, and so the last general evaluation of all real estate property in Germany happened on the 1st of January 1964, and then for 50 years or so nothing happened anymore. And in East Germany the last evaluation was even in 1935. So these values, which were fixed for as market values for tax purposes, were very, very out of time, and until 1996 these values were nevertheless still taken as the tax value of real estate property. So was a very, very easy way to avoid inheritance taxes in a legal way, to take 10 million in cash, buy a building for it, and that building would then probably only be valued, although it had a present day market value of 10 million, would perhaps then only be valued with, let's say, 500,000, because that would have been the value in 1964 on the 1st of January. That system was correctly criticized as completely unequal treatment of equal things and had to be abolished. So houses had then to be valued with their present day market value under the new inheritance tax rules. Okay. Then, then when people had to pay correct inheritance tax on the market value, and sometimes there was not enough money available to cover the inheritance tax, and so people cried for help and free allowances. And so the legislator, under the pressure of public opinion or of some people, tried to create some special exemptions for the transfer of houses between family members. And then naturally you had again to defend that against abusive behavior. So complications followed from that already. It's always the same basic mistake or the same sin, as religious people would say. You violated fair treatment and fair valuation and equal treatment, and then you have to draw a line to defend that against abuse, and that's in theory not even possible. And so you end up with more and more complicated rules. So that indicates probably that the whole thing is doomed and cannot be upheld, that the system should be changed in the long run. Well, in the beginning, even that exemption for the transfer of family homes was only granted for family homes within Germany. Then we got even problems with the European Union law, because European Union law says capital investments abroad must not be discriminated against in comparison with German capital investments. And now, if you buy a home in Germany, that is a capital investment. And if you buy a house, a family home, in Mallorca, Spain, that's also a capital investment. And so when inheritance tax gets due and treats these two things differently, and the Spanish investment is taxed by the German state higher than the German one, that is a violation of EU law, of the freedom of capital. So we had to change that and extend that family home exemptions also to family homes in the European Union territory and in the territory of the European Economic Area sometimes. So, yeah. So, if you grant exemptions, problems, usually because you can always cleverly transfer your property into another form. My standard suggestion is the problem is probably not that you need exemptions. The problem with inheritance tax is the liquidity drain which suddenly hits you. And if that were limited, for example, if one took the solution that you have to pay the inheritance tax without any free allowances, but only every year 1% of the amount inherited, until after 7 years, 11 years, 30 years, or what else, depending on your personal tax rate, until after all these years you've paid off your debt, then the whole problem economically would probably vanish. Now, another aspect, let's think about personal tax liability. You know that personal tax liability in the income tax distinguishes between an unlimited tax liability where you look to everything which happens in the world, and a limited one where your attention is limited to what happens in Germany. Now you have to make the same decision when you conceive an inheritance tax. Are you going to tax everything which happens in the whole world between your taxpayers? Or do you limit your tax claim to what happens in Germany? Now, imagine if somebody lives here in Germany and you only tax German donations and German property. What would happen then? Well, then if death is coming, I feel it, I transfer all my property to a bank account in a foreign country. Or if it's not feasible with a bank account, then I take all my property, sell it, transform it into cash, and buy a building in a foreign country where no tax will be claimed. So the basic conclusion from that simple example is, if you want that an inheritance tax works, you can only tax things on a worldwide scale. Otherwise, it is too simple for your people to escape such an inheritance tax claim. So at least when people live in your own country, it is absolutely necessary that you establish an unlimited tax liability claim for everything where these people are involved, so for every donation which happens worldwide. Yeah. So in Germany, the solution is unlimited tax liability if one of the people involved lives in Germany. Only if both of them do not live in Germany, then we have a limited tax liability, otherwise not. Okay, then another aspect. I already told you that when an inheritance tax is claimed, that lowers your equity, because from your net property which a business has, after such a death or a donation, a transfer of the business to the next generation by a voluntary act, let's say 30% or even more vanish between a short time, because inheritance tax has to be paid and the owner will have to withdraw the necessary money from the enterprise. Now, what does it mean for a common market where businesses compete with owners in different states, and the inheritance tax rates and legislation is different in all these states? Does that then have an impact on the ability to compete? And, well, let's have a look. Now, what you always must know is, in contrast to what economists usually do, when you want to make a realistic analysis, then you should not compare the business owner in Germany having invested 10 million there with a business owner in a foreign state having invested 10 million euro there, because at different places you have different productivity, different surroundings, different circumstances. So it might be that if you find out a difference caused by the tax, that difference for competition could be compensated or even overcompensated by other factors in which the two places differ. So if you want to make a convincing analysis, you should define that out. And so I have accustomed myself to a slightly different type of analysis. I just compare two people, one living here in Germany, the other one, let's say, in the Netherlands. I, by the way, don't know anything about the inheritance tax legislation in the Netherlands. It could just be now the abbreviation for a country with no law, NL, on inheritance tax. Okay. that's probably far better. So the one owner of an enterprise lives in Germany, the other owner lives in no legislation on inheritance tax country. And to make the two people comparable, we just say both have exactly the same investments at the same places, doing the same activities. So our German-based owner has one shop in Germany with a value of 10 million net property and one shop abroad in the no legislation country, 5 million. If that owner now dies and has a tax rate of 30%, then of the equity of 10 million, 3 million are gone. From the equity of 5 million, 1.5 million are gone. So we have 30%, that's 4.5 million of the equity which are lost. Now, imagine the other business owner lives in that no legislation on inheritance tax country. That's NL abbreviated. And so that owner also has a shop in Germany with 10 million investment, doing, by the way, exactly the same economic activities at absolutely comparable places under exactly the same conditions like in Germany, like the German competitor, so 10 million with the same productivity, and so no difference at all to the German competitor. Then that person also has under limited tax liability to pay 3 million from the 10 million, but the shop abroad, 5 million equity, no inheritance tax, 5 million are kept. So after that events happened, the competitor from the low or no tax country has, in my example, an equity advantage of 1.5 million because that firm remains stronger by 1.5 million due to the lower total amount of inheritance taxes which have to be paid. And that shows that there is now a competitive disadvantage because of the different conditions and even different tax rates between two countries in a common market. Two people do the same things at the same places under exactly the same conditions. They only differ by their private home, and now their businesses have competitive disadvantage, which, as according to our definition of the situation, which can never be compensated in the future by other differences in competition. By the way, you might even find exactly such a constellation in the real world if the German and the no legislation owners, if they have a partnership and start with a 50-50 percentage, and that partnership formed by them owns one shop, Germany, and one shop in NL, and then both die, and the one partner has to pay more inheritance tax than the other, so the drain on the equity will be different. And as it's the same partnership with the same partners earning the same money, sharing the same money, sharing the same activities, there is no chance for the partner who is worse off ever to compensate in the future the difference which the tax made for the competitors. And this shows there must be a solution because that can strongly distort competition. It's a problem for equal chances in competition. What can you do? First, the European Union could and should harmonize the tax. Unfortunately, that has never been discussed. Legally, it would be possible. The EU can issue directives, binding orders to adjust the member states' laws on every field which is relevant for competition in the common market, and it's accepted that that also covers tax matters. But a tax directive or a tax relevant directive requires a yes vote of 100% of the financial ministers of the EU states united in the European Union Council of Ministers. And it's 27 different members, and that 100% yes vote is not easy to get. That takes years. And as, let's say, 1/3 of the EU member states does not even have an inheritance tax law at the moment, it's nearly impossible even to try to get that majority, that amount of a yes. So what can and will then happen? Because what can people then do if their own people face disadvantages in competition? Well, the only thing you can do is to try to be the state who grants the most favorable conditions so that the distortions are now to the disadvantage of the people from other states. So you start in the end in the field of inheritance tax with regard to competition aspects a race to the bottom. As long as you are the state with the lowest tax rates, the distortions don't matter. Then they bring along advantages for your own people. And indeed, that is what has happened, although nobody ever discussed that widely. We have seen a very, very brutal tendency to reduce inheritance taxes, at least where they play a role for competition. So in the field of business property, and that explains that, for example, Germany, although we uphold high rates of 30% or 50% or so, completely renounces on taxes on business property if certain conditions are met. Just probably to grant our people the best feasible competition conditions. And so the race to the bottom here has already reached, unnoticed by the public, its optimum or its final stage, a zero rate nearly. That usually can't be the solution. So if you see that as a reasonable tax and a necessary tax, because otherwise there might be injustices in your tax system, if the tax on property is completely missing, then you have to redesign the whole tax properly, and you have to think about a harmonization within the European Union. And naturally, that would be a great task to debate about a conception where such a reformed inheritance tax could be made first effective, but second so low, or with such a low and survivable impact on businesses that you really could get all the fiscal ministries of the EU to accept such a proposal, and that you could motivate the European Commission even to try the untryable and even make a proposal of for such an harmonization of inheritance tax. Well, that should be enough to give you a first impression of what inheritance tax is about. And here, last but not least, a small overview about the structure of the German inheritance tax law, if you ever get confronted with that. The inheritance tax law in Germany is called the Erbschaftssteuergesetz, because Erbschaft is the German word for inheritance. And yeah, so it first defines the taxable transactions, that is, taxable are inheritances and donations or gifts. Then they explain to you who is subjected to unlimited and who is subjected to limited tax liability. Then they define the taxable transactions, and the tax base will be computed under the rules of Section 10, tax exemptions in section 13, 13a, b, c, d. So, for example, the exemptions and the conditions for business property are laid down there. Section 14 lays down the 10 years are always added up rule, and paragraphs 15, 16, and 17 give the tax clauses and the personal free allowances. 19 defines the tax rate, and afterwards then we end up with some other bureaucratic stuff about tax returns. So there is still to mention paragraph 21, the credit method for inheritance tax already paid abroad on property which is located abroad, but that's in principle, that's it. Okay. That should be enough, and you have seen there will be another chapter on matters of procedural law sometime. Not now. Thanks for watching. I hope you survived this, because if you died from being bored, that would trigger inheritance tax, and that would be rather sad. So sad. Because if you trigger the tax before you know how it's done, that would really be a waste of time. So don't die, enjoy your lives, and come back to this channel whenever you are motivated to learn a bit about taxation. Thanks and goodbye.